All right, what is up, guys? So today's video is going to be about candlesticks. It's the second installment in the strategy series that I'm going to put out. This is going to be just basically talking about candlesticks. I did put out a YouTube video about this discussion already, but I'm going to kind of put together this strategy series basically from beginning to end. And this is going to be number 2. The first one was the trading view tutorial. All right, so if you're absolutely brand new, a candlestick's data is made up of 4 parts. You have your high, your close, your open, and low, all right, for a bullish candle. And on a bearish candle, it's just basically what makes the difference between a bullish and bearish candle is on a bearish candle, your closing price is going to be lower than the opening price. And on a bullish candle, your opening price is going to be lower than the closing price. All right, so if the candle closes higher than the opening price, that's going to make a bullish candle. If price closes lower than the opening price, then it's going to cause a bearish candle. All right, and that's pretty much it. The other, like I said, high, open, low, and close is the only 4 points that of data that a candlestick gives us. Now, you can literally search up candlestick patterns and formations on Google and spend days and days and days learning the millions and millions of candlestick patterns, chart formations, and the names for all of those things. Or you can take a simpler approach to technical analysis and understand that there are only 3 kinds of candles. Now, it does not matter which time frame that you use. Each time frame, 15-minute, 30-minute, hour, all that is in reference to the price range given in that specific time. So I'm looking at an 8-hour time frame. That means that each candle is an 8-hour range of price action. All right. Now, the 3 kinds of candles that there are is an outside candle, and an outside candle is also known as an engulfing candle, but I call it an outside range candle. That's the name that I prefer, or an outside day, whatever floats your boat. It's an outside range, meaning you took out the high with this wick and you took out the low with this wick. All right. This candle's range takes out the entire range of the previous candle. All right. So we can't dictate the future. We're not fortune tellers. We don't know what's going to happen in the future. So knowing that there is only 3 things that the candle can do from this point in time at which you are at on the chart, it can give you an edge. All right. So basically you have this trending candle that comes up, makes a high, and then it closes on high, has a nice bullish, strong close. And then your very next candle is a bearish engulfing or a bearish outside candle. Now, this isn't technically the kind of outside candle I like, as the close was higher than the opening price of this bullish candle. For this to be a true outside range candle, it needs to close lower than the previous candle. All right, so this is your outside candle. You did not technically take out the high of this. All right, you did not, but I'm just using this as an example. It just pretend that it went up another 5 pips and took out that candle's high. Then this would be the exact definition of an engulfing, or aka outside range candle, as you took out the high and then you closed lower than the previous candle's opening price. That makes it an outside range candle. All right, so moving forward, outside range candle is that's one way. The second type of candle is an inside range candle, meaning you do not take out the low of the previous candle and you do not take out the high of the previous candle. So basically, for an inside candle to be an inside candle, it must trade inside the range of the previous candle. So you didn't take out the high, you didn't take out the low. Both the high, low, open, and close was inside of this candle's range. That is an inside candle. And finally, the last is a trending candle, meaning you only take out one side of the previous candle. Either you take out the top side of it, and that would be a trending candle, or you take out the bottom side of it, being a trending candle. But this is an outside candle. This is a perfect outside candle, as you did take out the high and low of this candle. You did close below, all right? But this big candle here is just a trending candle because it did not take out the high of the previous candle. It only took out the low, and it closed below the low. That makes it a trending candle. It has to close below the low. If you come down, take out the low, and then close up here, it's technically not a trending candle. It did close lower than the previous candle, but it didn't take out the previous candle's low with a closure. That indicates a trend is taking form. Okay, you got that big bearish close. This is a retest. You could have gotten short on that, and yes, it's hindsight. I understand that. That makes up the only 3 kinds of candles that there are. All right, if you look at every single candle that's on every single chart, there's only 3 distinct different candles, and that is it. Your inside, your trending candle, and your outside candle. And that will help you to basically navigate these markets. Now, a range is, all right, so let's use this high, all right, right there, and let's use the low right there. All right, so basically, until you take out the high or you take out the low of this candle, every single one of these candles right here are trading inside of this candle's range. All right. These candles attempted to break below the range. This one did too, but it closed back inside of this candle's range. All right. That's important to understand, because on the instant you get a number 2 candle or a trending candle that closes outside of the range, then that indicates a trend is going to either continue or it can also be reversing. So just keep that in mind. All right. Whenever I say range bound or choppy markets, this is what I'm referring to. It's very hard to take profitable trades in any of this right here, because price is just chopping back and forth. You're making here was a lower high, higher high, but this made a lower low, this made a higher low, and this right here made a lower low. So like, you can get really annihilated trying to trade within that. So what we try to do as traders is we look for the higher probable areas to trade. And inside of these videos, I'm going to do my dead level best to teach you exactly what I'm looking at when I'm analyzing a price chart. 3 kinds of candles: inside, trending, outside. That is it. There's no other kind of candle, and there's no other formations you need to understand other than those 3. Once you really start to understand those things, it's going to really help your trading out tremendously. And that's our promise. All right. So we can go look at a few other examples if you wish. Right here is a nice outside candle. It wasn't a beautiful outside candle, as we didn't close above this opening price of this bearish candle. We closed below it, so it's kind of like a fake out. But then you had a big, strong trending candle that took out this candle, and this candle's range. So right there in those 3 candles, you took out all of those candles' range with these 2 candles, basically. That indicates possible trend direction change. All right. So we will go on further in depth in these videos, and I'm going to, like I said, I'm going to do my best to teach you what I'm looking at. And obviously you're not going to be able to get it just from watching these videos. It's going to take time and practice and failure and many years of practice, and then eventually you're going to be able to suss out direction of the markets. All right, so with that being said, I'm going to end it there.